Hi everyone. The Indian stock market is booming in 2022. It is incredible. Since the COVID pandemic, the Nifty 50 dropped slightly and then has just been on an uptrend ever since. This is in total contradiction to all the rest of the markets across the world, which have been on a downtrend for the past 6 months to a year. In fact, in 2022, I think the Indian stock market is one of the best performers across the world. So what is driving this strength in its economy, and what does that mean for us, and how can we take part in this little increase and boom in the Indian stock market? So let's have a look at, first of all, the Nifty 50. Okay, so what has it done? Well, let's look at the 5 years, the 5-year chart. So you can see that back in the end of 2017, start of 2018, we were around about 10,000. And as of now, we're around about above 18,000. So that's about an 80% increase in 5 years. If we compare that to something like the FTSE 100, you can see the FTSE 100 is around about level for 5 years, despite dividends. And let's look at the powerful NASDAQ. So even the NASDAQ surged ahead of the Nifty, and it is back down below the Nifty. So the Nifty's up 76% in 5 years, and the NASDAQ's up 61% in 5 years. Let's check the year to date. So in the year to date, we can see that the Nifty 50 is outstripping even the FTSE 100, which is doing pretty well this year. So what is driving this strength, this relative strength in the Indian economy? Well, there's a couple of things at play here. So first of all, the American stocks are taking a little bit of a hit. So technology companies are going down in price because during COVID, lots of people turned to technology, and now we're seeing earnings decrease back down to a normal level. Similarly, in China, there's more lockdowns happening, very strict COVID policy, and that's impeding sort of growth and stopping the economy from really growing as much as it used to do. So investors are looking towards India at the moment. They're looking for bargains, and that is why lots of people are starting to invest in India, and which is holding up the market. And so what we're seeing now is every time the stock market drops a little bit, it tends to increase back up. There's a massive market in India as well. So it is the most populated country in the planet now, at over 1.2 billion. I think over 1.3 billion if I remember correctly. So it's a massive, massive market, and it's still a very, very highly growing economy. So there's lots of potential there, lots of potential for tech companies to really make their mark. There's an explosion of sort of food delivery services, and banks are doing well, technology companies are doing extremely well. So that is what we're seeing. We're seeing the inflow to India because it's got the best growth potential out of any economy at the moment. So how do we get as a UK investor, how do we get to invest in this market? And I'm going to go through, if you're a US investor as well, you can kind of do the same thing, and there's a few extra things you can do, which I'm going to pick up on the end of the video. So for the UK investors, the best option that I have found is the Ashoka Indian Equity Investment Trust, PLC. So what is an investment trust versus a fund? Well, a fund distributes all of its returns to investors at the end of each year or during the year, whereas an investment trust is allowed to hold on to 15% of those gains to kind of smooth out returns over the years. And also an investment trust is allowed to take on debt and try and accentuate the returns, but of course it also accentuates the risk as well. So investment trust is a little bit more risky, but you could potentially get more return. The Ashoka Indian Equity Investment Trust is by far the best performer that I can see. Please leave me a note in the comments if you found an investment trust that is focused on India that is doing better. But what I would say is investing in India is really quite difficult if you are based in the UK or even probably in the US, because it's not it's not readily available for us on our platforms, on our stockbrokers, to actually invest in India. We kind of have to do it through funds. It's not very easy to invest in the individual companies, but I will show you how you can do that at the end of the video. So this investment trust has done really well. It's been following the Nifty, and in fact doing slightly better than it. And the reason that the Ashoka trust is doing better is because it is invested in the biggest companies in India, which are not only focused on the Indian growth, but also a slightly more global view as well. So if we just have a little look at the holdings, I mean, I've got all the fact sheets for these three trusts and funds I'm going to show you. So what I'll do is I'll add them in the comments below, so you can just click on the links and you can see these fact sheets is what they're called, and you can see, just sort of compare for yourself if you're interested. So what we can see is we can see the top 10 holdings, and we can see that bank, ICICI Bank is the top holding. Banks have been doing quite well as the interest rates have gone up. Infosys, which is the sort of, in the UK, it's infamous for Rishi Sunak's wife holding 1% of the company and then doing quite well out of that. And you've got things like building materials companies as well in there. So lots of very strong companies, and they are outperforming the Nifty itself. So that is adding quite a lot of beef to the Ashoka Investment Trust's returns. So you can see that there's a sort of net assets here of 225 million pretty much. So you can see it's not a huge fund, not a huge investment trust, but it is growing. And you can also see, this is the important part, is the ongoing charge of 0.32%. Now, the Ashoka Investment Trust also charges a 30% charge on the gain. So if they make a profit, they take 30% of that for themselves. If they make a loss or they don't make anything, they don't take any money other than this 0.32%. So that's something that's not too great. It sort of caps your gain, but also it's one of the only ways to sort of invest in India. So the second option here is the Aberdeen New India Investment Trust. So they have not been doing as well as the Ashoka because they're more generally spread across the Nifty, and they have been investing in companies that haven't done quite as well and not as robust. So the fact sheet here shows that they've got about double invested. The assets around about £450 million worth. You can see the annual management fee as well is 0.85%, as well as the ongoing charges of 1.06%. So really high management fees and ongoing charges, whereas the Ashoka is only 0.32, and that's it, no other management fees. So you can see already Aberdeen, the Aberdeen Asset Management Trust Fund for India is 2%. So it's around about 2% more than the Ashoka one, which is quite a big difference and probably eating into their gains. The third option is the India Capital Growth Fund. So I've got the fact sheet here. It's its own thing. It has about, where are we here? 134 million worth of sort of net asset value. And you can see the AMC is the annual management charge, which is 1.25%. So again, quite hefty there, and you will be able to see that over the sort of 5-year period, it's also not performing as well as the Ashoka. So Ashoka definitely is the standout, but if it continues to make profits, then of course you're getting 30% of those profits taken away. But the ongoing management charge is the lowest, so which is why it's doing the best at the moment. So it is obviously investing in the right companies, investing highly in technology, which is one of the growth sectors in India. India definitely seems like it's on the up, especially because all the rest of the economies are on the way down. So it's definitely one to consider for your portfolio if you want to just add a little bit here and there. It's definitely something I think I might be investing in the coming years. But of course, do your own research. As for American consumers or anyone that's got access to American stocks, you can invest in a few ADRs, which are American Depository Receipts. And what that kind of means is that it's sort of like an imitation of a stock from a foreign country. So an ADR for for ICICI Bank would just copy the sort of share price in India. And so you can see here that ICICI Bank has done very well, and that's Ashoka. That's the top holding for that Ashoka fund, investment trust, which you can see why Ashoka is doing so well. So if you have access to ADRs, American stocks, then you could purchase this instead of buying the investment trust or fund. And then there's, you can see another one here, Infosys, which is the second sort of biggest holding, and you can see that also it has done not too badly over the past 5 years. It's contributing to lots of the gains of these funds and investment trusts. So you can invest directly in them if you have the ability, but of course, it's more risky than investing across a breadth of companies. And the last thing I want to show you guys was the Nifty 50 is kind of like the FTSE 100. It's broken down into 50 different companies, and I've got that by market cap. So here we go. Let me make this a little bit bigger, and you can see what the biggest companies in India are on the Nifty 50. So you can see at the top is Reliance, and then we see further down, fourth and fifth, you got Infosys and ICICI Bank as well. There's a few different companies, TCS and HDFC Bank. So some big financials in there. Lots of banks and financials and tech in there in the top companies. So because India has such a big population, we should expect them to continue to grow. So it seems like there's good potential here for India, but as always, India's had quite a big political risk. It totally depends on how the leaders run the country. And usually there can be big swings in sort of shift in sort of mentality. But at the moment, India is probably considered quite a bit more of a safer investment than before, considering the world's turmoil we're going through and the sort of Russia-Ukraine war, and China as well being a little bit sort of very kind of like locking down in COVID, and some sort of tensions between China and the US, potentially sort of like a cold war with trade. So India's probably seen to be a little bit more of a safe haven at the moment. If that reverses and sort of the China investments start doing well again, and American tech stocks start doing well again, we might see some of the money coming out of China and then back into the relative safety of American tech stocks. So there we go, guys. Hopefully that gives you some insight into how to invest in the Chinese stock market. I find it really interesting, so hopefully you do too. As usual, you can check 2 of my videos here and here. Please do like and subscribe, and leave me some comments below if you have found any other good sort of ways to invest in India, or if you thought that was useful. So I will see you soon.